Okay, right. So what we have here is a scenario where you're given overheads, and the overheads are 36,000 per month. You're told that this is estimated 36,000 per month, and we're also told that we delivery costs are to be, which is what's telling us here, a portion on the basis of delivery miles. So if we have if we have a guesstimation of 36,000, and if you like it says apportioning on the base of which is £4,000 a month. We're apportioning in effect £9 per mile. This is our guide, the overhead absorption rate. Right. So anyway, what happens now is the question is asking what's the net profit for this small group of shops? Well, it's not too bad. 600 times, if you like, this is the number of orders. That's the revenue per order, isn't it? So you have 60 times 100, which is 60,000. And if you're charging £9 a mile, and you have 8 miles per order, and you have 600 miles, so that's 9 times 8 times 600, that's 43,200, which is the cost involved. Take that away from the 60,000, and that gives you the 16,800, and that takes us to D. That takes us to D. Right, so let's see what we have here. So here it says here, you have here the costs. These are the costs involved. This is a large customer. For this group of customers, so your income is 390 for the year. They make 260 deliveries. So, and they placed 2,200 orders. So taking an order in itself is a cost. So 2,200 times 90. So now we need to think about delivery. And you did 2,600 deliveries. That's 10 kilometers per delivery, and therefore it's £4 per kilometer. So you now have, so changing my pen color, what you now have is where you have 2,200 times 90, which gives you 2,200 times 90, which gives you 198,000. And you also have 2,600 times 10 times 4, and you also have a cost of 104,000. So the profit, of course, will be the 390,000 minus the 198,000 minus the 104,000, which brings us to 88,000. That's question 2. So find the cost this way, and you're there. So here we have some target costing. So we have target costing. So the question says here that this is your target profit, and your desired profit is 10% of the target price. So 120 minus 10% of 100, 10% of 120, that's 12, of course. So it means that your 120 minus 12, 120 minus 12 takes us down to 108. So currently, this is our target cost. This is estimated cost of production right now is 108. So this is perfect. You don't need to redesign the product. You're fine. Your whole aim is you're trying to bring your cost probably would have been higher, so we're trying to shave those costs off to bring down any issues. So here the answer is D. You don't need to redesign the product. Let's look at this one this time. So we have 1,300, and we're trying to bring it down to 50 by 15% of that 1,300, right? So the question then, what is 15% of the 1,300? That's 195. So 1,300 minus 195 is 1105. This is a month. Right, okay. So estimated cost of production is 102. Sorry, this is a year, what I just calculated. Estimated cost of production is 102 a month. So this is my target. My target is 1,100. So what I should do is multiply 102 by 12, and I get 1,224 for the year. So this is what I'm trying to get it down to. This is what we're currently doing. So the question here is the difference of 119 is what we're trying to reduce our cost by. So because we're trying to get it down to 1,105. Yeah, we're trying to get it down to 1,105. So 119. Yeah. Okay, right. Yeah, so let's look at this, right? So here we're talking about the theory of constraints. Um, So our focus here, really important here, is about throughput. You need to look for this word throughput. So when you see the word throughput, you're like, ah, right, I'm focusing purely on the material. But they do give it to you, to be fair, they give you. But it doesn't really matter. If they didn't, you'd have said sales minus the material cost, right, being the only significant cost when it comes to throughput. So you would say, um, you would say, you would focus on that. And here they give it to you. So you have £10 and you have £15. Now, the first question we need to ask ourselves is, well, how long is it taking to make each of these units? I mean, I can just simply ask, well, how much throughput am I getting per minute? It really doesn't, whether you take it to hours, it doesn't really matter. The point is, I'm getting £2 for every minute invested. I'm getting 1 that's 1 3 over 12, 1.25. So I'm making more money per minute that we're spending on this bottleneck we're hoping to improve on pots. On pots. So make pots first. Make your 300 pots first. That's the first point. Make your 300 pots first. And where are we? Here we are. So make your 300 pots first. So let's do that. So if we're going to make 300 pots first, and we need 5 minutes to make each pot, well, 300 times 5 minutes, 300 times 5 minutes is 1,500 minutes. And then when I divide this, um, by 60, you get 25 hours. So I need 25 hours, right? You have 35, so it means you have 10 hours left to make kettles. You have 10 hours left to make kettles. So now, I guess the question then becomes this. If you have 10 hours left to make kettles, you have 10 hours left to make kettles, and it takes you 12 minutes to make one kettle. I suppose the question here is, how many kettles can you make in 10 hours? I suppose you could multiply this change this into minutes. So that's 600 minutes. So I suppose 600 over 12 is where you're going, isn't it? 600 divided by 12 takes you to 50 kettles. So you can make 50 kettles. You can make 50 kettles. Right, question 6. So the throughput accounting ratio, which we looked at, is a relationship between throughput contribution ratio versus the sort of factory cost per hour. We're really looking at the ratio of return over costs, so to speak. Is it worth pursuing the project? So let's first of all look at the throughput contribution ratio. It says that you're currently selling at a price of 7.75 per selling price, and it's costing £4. So you're making £3.45 on every unit, and it says it takes an 1 hour. So in effect, 1¼ hours generating £3.45. So let's find that first. Let's find the throughput per hour. That is 2.76. So this is 2.76. Okay, no problem. Now we know that the factory cost is 1,500, and the total number of hours currently is 300 machine hours. So each machine hour is generating an overhead cost, or cost in general, an overhead cost of £5, £5 an hour. So what we're really looking at is we're saying that, listen, when we make this product, the product is bringing in £2.76 an hour, but the costs being generated by the rest of the work to get it done is £5 an hour. So we can find that relationship in what's referred to as the throughput accounting ratio, you see. And that's 2.76 divided by 5. Ah, right. I've made an error somewhere because I don't have the answer. Let me look at that again. It's 300 machine hours. The factory cost is 1,500. I have this as 5. £7.75 minus 4. Sorry, this was £3.75. Forgive me. £3.75. £3.75. So £3.75 divided by £1.25 was 3. So this was 3. Forgive me. So this is 3. This is 3 over 5, and that's 0.6. So your answer is B. Right, let's move on to question 7. So with question 7, it says they make radio sets, and each sells at £22, variable cost of 15, which means that we have a contribution of £7 on each radio set. So if we have fixed costs of 98,000, well, that means that um, we need to sell 98,000 divided by 7, which is we need to sell 14,000 units in order to break even. That's the point there, isn't it? Now, I'll do this kind of how I taught you this. I said that if you think about breaking even first, so let's break even, and then let's find out how much we need to sell to make this profit. So it says here that the fixed costs are 120,000 a year. So let's break even first. If I'm selling each table for 78 and it's costing me 60, I'm making 18 on each table. And if my fixed costs are 120,000, I need to first of all sell 120,000 divided by 18, which is not a very pretty number, which is 6,666, first of all. Now, it then says you need to go ahead and make a further profit of 15,000, and I'm making 18 on every table. So therefore, 15,000 divided by 18 is 8,333. So I need to make an additional 8. So in effect, add this 8,333 to your 6,666, and you'll get 7,500. I suppose you could just have added the two together. So the 120,000 plus the 15,000 divided by, which is how you see it in the formula, by the contribution per unit, right? And then you still get the same answer. Cool, great stuff. So that's D. That's D. Right, yes. So in making decisions about whether or not we stop making a product or not, we need to ask ourselves, is that product making a contribution to the whole process? That's the point here. If it is, then we're safe. So look at this. You have 7,000 valves at £10, and that's 70,000. And then you have variable costs of these 7,000 valves. Yes, £7.10 times 7,000, and that's 49,700. And then you have these divisible fixed costs. So the term divisible is a technical term for unique or costs that we can allocate directly to the product. And so these are divisible at £2 a unit, 7,000, which is 14,000. Right? That's what we're sort of doing here. So the question of contribution becomes 70 minus all of this to find out what the contribution is, and is it worth it. So let's do 70,000 minus 49,700 minus 14,000, and that's 6,300. So it's making a 6,300 contribution. We don't include these because these are non-divisible. What non-divisible means is that they are large overheads that we have apportioned based on some base. They're not directly connected to that department at all. right? So always leave that out when making this decision. The point is that this non-divisible cost will be there whether or not you stop making the product anyway. So it's not relevant in that decision. Opportunity cost just really means, well, what's the benefit you lose out on if you accept a particular order? So you have this scenario here. Um, if you to decide to go for order B, you're missing out on going on order A. It's just saying, that's what opportunity cost is. What is the benefit forgone? What are you foregoing by making a certain decision? Well, if you only have time to make B, it means you're going to lose out on A. So the question is, what is A? So A says, listen, you can get £110, which is 1,000, and then take off the variable cost of A, of course, which is 100 at 5, which is 500, which means that you are losing out on the potential contribution for £500. Remember, we ignore these fixed costs when we analyze in the short term when making these kind of decisions. So the answer there was B. The answer there was B. Relevant costing. So again, we did a number of these, and if you've been doing the mocks and if you've been doing the progress, you will come across this. If you've done the question bank, this should now become quite normal for you. The company needs 2,400 kilograms of gravel. They have 1,500. It says that they can't use this. So the key point here is that this is the opportunity. This is the value of that £3.50. And then you need to go out there and buy the balance. So you need another 900 kilograms, don't you? And that 900 kilograms can now be bought for £6. So this is the total relevant cost. The fact that if one person department gives you this, they're losing out on 1,500 times £3.50, which is 5,250. Plus, of course, here we have 4,500. 9 times 6 is 45. Sorry, 9 times 6 is 54. Forgive me. 5,400. 5,400 plus 5,250. And you have here 10,650. 10,650 as your valuation. Right, good. So key point here is that whenever stock can be sold, is as in if they're not using it, then the relevant value becomes what you can sell it for. Right? So that's that. Here we are sort of looking at contribution, really. There's nothing really new here. Key factor analysis, the key data available for maintaining this. Okay, no problem. So here's your contract income, 110 income. Your materials are 5 times 6, which is equal to 30, right? And your so let's just do it. We're just really calculating minus 30, and then 2 times 16, which is the skilled labor, which is 32, minus 32. And then you have further unskilled labor, which is 36. So let's find that out. Let's find out what that total contribution is first, isn't it? 30, 32, and 30, 36. So you have 110 minus 30 minus 32 minus 36. You have £12. Now it says what's the limiting factor is skilled labor. You need 2 hours of that. So in effect, you're saying what's 12 over 2, which is £6. You're really asking for every hour of skilled labor that we have, or how much contribution does does an hour of skilled labor lead to? Which means if we have a scarcity of skilled labor, then we know what to do. Then we know what costs are involved. And that's £6. Right. Here we are. You have a scenario here. Question 13. Again, I want to highlight that we always ignore these non-divisible fixed costs. They were going to be paid for anyway. They have to be paid for. So this company currently produces 500 units. A subcontractor is offered to supply it at 340. So let's see how much what we do with this thing. So currently, it costs us £100 and 75 in terms of material and labor. This is directly attributable to it. So you can find, or should we just do the totals? It doesn't, oh yeah, let's do the totals. That's better that way. So that's 175. So I'll multiply that by 500. So I'll have 100 plus 75 times 500. So 87,500 is the current. Well, it actually, you know what? Let's just do it like this. It doesn't really. So we're very clear. So we have 100 times 500 units. We have 75 times 500 units, and then we have directly attributable fixed costs as well of 87,500. So this is 50,000. This is 37,500. Add everything together, and we have 175,000. It would be our spending. Let's say we had gone with this option of 340. So what we really need to do is multiply 340 times 500, and we get 170,000. So we buy it, we spend the 170, we make it in-house, we spend 175. So it says if you accept the offer, you will be saving, won't you? Rather than if you accept the offer and choose to buy it rather than to make it, it's cheaper to buy. So you'll be better off. Certainly. Question is how much more? And the difference, of course, between this and this is 5,000. So you'll be 5,000 better off. You'll be 5,000 better off. Exactly the same principle here. Company manufacturers want 10,000 units. Each unit requires someone has intended to supply the component at 725. We'll just keep that for now. But let's see in terms of making it. So we need 2 units of X to make this. So we need 2 times, in fact, times £5.50. Component X has a variable cost of £5.50. We need 2 of them. So 2 times £5.50. And in making 10,000 units, in effect, that's what we have. And then we have this divisible fixed cost of 35,000 as well for the month. Oops, sorry, we got there. So in effect, let me find this one, the 2 times 10,000 times 550. Let's do that. 2 times 10,000 times £5.50 is 110,000. Add on the 35, and that's a total of 145,000 to make this product in-house. Otherwise, the supplier is willing to give this component X at £7.20. Supplier has offered to supply this component £7.25. So it's the component. Okay, right. So £7.25. Actually, I know what to do. £7.25. If they give us that component, £7.25 times 2 times 10,000. 25 times 2 times 10,000 is, we have 145,000 exactly as well. So no, there would be no saving. Your answer here is A. Your answer here is A. There'd be no saving. They're exactly the same thing, aren't they? You can see that. Exactly the same thing. And the final question says that, let's look at this here. Yes. Right, and so we see here in this very final question here, it says that the cost of making this joint product can be sold. The joint product can be sold at the split of point for £11. Right. So, but you can So it's valued at £11. So we can do some more work to it at a cost of £4. So technically, we would have therefore put in a complete value of £15 on that product. But it only has a market price of £14.50. So if you do that, you're in effect making a loss of 50p on every liter as you're going, because that's the difference. Right. And that brings us to the end of Mock 6.